This is the Daily Market Comment by Harlan Bospiceros. I'm Maria Bashirdias. Thanks for joining us at XM.com. The dollar traded slightly higher against most of the other currencies yesterday, but it came back under renewed selling pressure today. It seems that dovish market expectations about the Fed's future course of action continue to weigh on the greenback, and this is evident by the slide in Treasury yields. Investors slightly lowered the level where they expect interest rates to peak, while they are still pricing in nearly 50 basis points worth of rate cuts by the end of 2023. And all this despite the Fed appearing hawkish last week and signaling that interest rates could rise to slightly above 5%. With inflation, as well as one-year inflation expectations continuing to cool, market participants may not be willing to listen to what the Fed has to say now. This kept the dollar under pressure, even during periods when equities were sold, suggesting that the inverse correlation may slowly be breaking. Therefore, even if the currency attracts some safe haven flows due to increasing recession fears, a scenario where it returns to its September multi-decade highs seems extremely unlikely. With the Bank of Japan tweaking its yield curve control policy, yield differentials between the US and Japan are now narrowing further, suggesting that the yen could take its dusty safe haven suit out of the wardrobe, while the dollar may lose the status of the ultimate safe haven due to retreating Treasury yields. Wall Street extended its recovery yesterday on the back of data revealing a rebound in U.S. consumer confidence for December, as well as upbeat Nike and FedEx quarterly earnings. The S&P 500 remains below the solid downtrend line taken from its record high hit back in January. This could mean that the outlook did not suddenly brighten, as concerns about a U.S. recession next year have anything but vanished. Indeed, according to data released yesterday, U.S. existing home sales tumbled 7.7% month-on-month in November, as the housing market continues to be hurt by higher mortgage rates. This comes on top of last week's disappointing retail sales and PMIs, and with the full effect of the Fed's tightening crusade not felt yet, the outlook could deteriorate further. Oil prices rose yesterday after crude oil inventories fell by more than expected, with both Brent and WTI crude futures for February gaining more than 3%. After hitting a nearly one-year low on December 9th, oil prices entered recovery mode, printing a higher low this week, perhaps helped by hopes that China would ease its COVID-related restrictions. Nonetheless, a discussion of a full-scale bullish reversal appears premature for now, as it may take some time for China's economic engines to restart and revive crude demand. This was today's Daily Market Comment. Thanks for joining us at XM.com.